Welcome, I'm Michael Lovett, Head of Intermediary Distribution for Vanguard Australia. This is a recording of the webcast titled The Myths of the Bond Market Bubble, which was filmed live on the 6th of June 2013. I hope you find it informative. Today I'm joined by Greg Davis. Greg is Vanguard's newly appointed Chief Investment Officer for Asia Pacific. Now Greg, you've recently located to Australia after serving as Head of Bond Indexing for Vanguard for the last 6 years. How have you settled in?
Very, very well, Michael. Very, very well. I mean, Australia is a really, really easy place to get used to. I guess in bond terms, the way I describe it, it's the type of trade that it is. It's basically up in yield, up in quality, but no change in duration. I mean, it's just been a phenomenal experience coming to Australia.
Fantastic. Thanks, Greg. Before we begin, I'd just like to remind you that the webcast will run more efficiently if you close any other browsers you have open on your computer. Also, we'd encourage you to submit questions during the webcast. We want to make this as real as possible. I do have a few questions that I'll start with. And lastly, this webcast has been accredited by the FPA for 0.5 CPD points. Greg, I'm going to ask you a couple to get going.
Okay.
Firstly, you used to run $250 billion of indexing bond money out of the US.
Yep.
You've obviously got a lot of experience in managing bonds. Can you just give us an update what you think is going on in bond markets at the moment?
Sure. I mean, when we take a look at where 10-year government bond yields have been, for the last 15, 16 years or so, you can see that, for the first 10 years of that period from 1997 to about 2007, they were in a pretty tight range in their respective markets. Here we're looking at a graph that covers Germany, the U.S., Japan, and Australia. And what you can see is that, at the beginning of the global financial crisis in 2007, you can see just a dramatic shift in terms of overall rates. And this was really driven by, the global coordination of easy monetary policy and stimulus measures to really get the economies back on track.
Thanks, Greg. Keep those questions coming in. I'll ask one more before we go to external questions. So the question we get asked all the time is if bond yields rise or if interest rates start rising, will the bond bubble burst, essentially?
Right. I mean, I guess it's the way to think about it, bonds, it's very difficult to say bonds are, in bubble territory. When I think of bubbles, I think of corrections that might be 20, 30, 40%. Bonds with their characteristics of payments, coupon payments, periodic coupon payments, the repayment of principal at maturity, it's very difficult to have a bubble scenario in the bond market, the investment grade bond market. What I would say is, and we have another slide that shows, the impact of bonds with a rise in rates. So here we're looking at the UBS Composite Bond Index, and with a couple different scenarios, a rise of 0.5%, a rise of 1%, and a rise of 2%, and the impact that would have depending upon your holding period, your time horizon. So in the first example there on the far left, you can see that, hey, if we have an immediate shift in interest rates, you could have, in a 200 basis point scenario, you could lose about 7.5% of your principal. But if you were to look out over periods of time, a 1 year, 2 year, 3 year, all the way out to 5 years, you can see that it's only once you get out to 2 years, even with 200 basis points of interest rate rises, you actually start to have a positive return again in the UBS Composite Index. And the key thing to note here is that when you look out beyond 4 years, you can actually see that having rising rates actually benefited you. You actually had a greater return because rates rose due to that reinvestment of principal and coupon payments over time.
It's interesting. I think many people remember 1994 when bond markets had a sort of similar experience where interest rates rose dramatically and they saw negative returns. So you think that is possible, but in the short term rather than the long term.
Exactly. I mean, it's very difficult to overall predict where interest rates are going. It's a very difficult call to make. It's market timing, basically. But what I would say is that, again, you could have a short period of time where rates rise and it causes some principal losses. But again, if you're a long-term investor and you're investing in bonds for diversification of your portfolio, you'll be fine in the long run.
No problem. We've got our first external question from Len in Sydney who asks, are high-yielding corporate bonds more attractive than government bonds at this point in the cycle?
I think the way to look at it, when we look at spreads on corporate bonds, they're fair value. They're fair value relative to the longer term, yield advantage over government bonds. The way we think about corporate bonds, though, is, again, you want to make sure you do it on a diversified basis. You don't want to invest, your assets in one individual security because you're taking on a lot of idiosyncratic risk. From the standpoint, if that issuer were to default or get downgraded, you're taking on a lot of risk. That it's better to do it in a diversified basis, and a fund structure is typically a very efficient way of doing something like that.
And we have another question. Stuart from Wagga in New South Wales asks, why would I use a passive strategy at this point? Sure, it makes more sense to have a manager making decisions about duration, security selection, etc., etc.
You know, it's a very interesting question. It goes back to, you know, something I alluded to at the very beginning. You know, market timing. It's very difficult to time when you should be getting out of the market or in the market. And the same thing holds true with trying to figure out if rates are going to rise or rates are going to decline. You know, if we were to take a look back at the original graph that I had up, you know, one of the things I would say is that a lot of investors thought in the U.S., I would say, that when rates got to 4% on 10-year treasuries, they weren't going to go much lower. Then they got to 3%, and folks thought they weren't going to go much lower. Then 2%, and they said the same thing. And ultimately, we got down to below 1.5%, and folks were still scratching their heads. So it's very difficult to predict what's going to happen with interest rates. The key, again, is, hey, bonds play a very vital role in a portfolio for diversification and income, and you really shouldn't try to time it.
And so, speaking of interest rates in the US, interest rates are at zero essentially. What do you expect to happen there in the sort of short to medium term?
I mean, I think you're going to see a lot of focus just on, you know, Fed speak. So trying to get a clue from what's going on from the Federal Reserve when they're going to start reducing some of the accommodation that they have in the marketplace. So there's just so much focus on every Fed speaker that's out there trying to get hints on whether or not the Fed's going to start pulling back some of their quantitative easing. I mean, in the short run, when I think about, hey, what the Fed is trying to accomplish, you know, ultimately they're trying to get unemployment down to 6.5%. We're currently at 7.5%. They have an inflation target of up to 2.5%. You know, we're still well below that. When you look at factors like capacity utilization in the marketplace, you know, there's no signs that inflation is picking up in the U.S. And we still have an underemployment rate, which we call U6, at about 14%. And what that basically says is that 1 out of 7 Americans is either unemployed or underemployed. So that's a pretty big statistic there when it comes to how much capacity you have in the overall market.
We have a question from Chris in Adelaide saying, do you see any value in listed income securities?
You know, that's an interesting question. I mean, I really can't answer that question in terms of listed income. I don't have a lot of familiarity with that.
And what about hybrids then? Because hybrids have been big and they're clearly listed securities.
Yeah. So hybrids, you know, in the U.S., and that's where, you know, where we had a lot of experience with hybrids back during the global financial crisis. We had a lot of investors who, you know, were again trying to seek out additional yield when spreads were tight and yields were coming down, and they bought into hybrids, not really understanding that it's part bond, part equity. And so you can get some very nasty surprises if you don't really understand the structures that you're investing in. So from a hybrid standpoint, we saw a lot of institutional as well as retail investors buy a bond thinking that it's going to have a 5 or 10 year maturity, just to find out when the economy started to turn down, their bond extended out to a 20 or 30 year type bond. And as a result, they end up having significant losses relative to what they thought they were going to have in a downturn.
Yeah. We have a question from Luke in Melbourne from Morrows. Do you believe government bonds are overvalued? And if so, is it prudent to follow an index approach given government bonds make up a significant proportion of the index?
You know, what I would say to that question is that, again, it goes back to market timing. You know, at the end of the day, the bond market is very efficient. And if you were to look at the shape of the yield curve, the market is already pricing in the fact that rates will rise over time. And if we were to look at the forward curve, which is a reflection of what the market is pricing in over the next several years, what we see is that depending upon which market, in Australia, the market's already pricing in that 5-year government bonds are going to rise by over 100 basis points over the course of the next 5 years. So it's not a question in terms of how the markets operate, whether or not rates are going to rise. If you're trying to make a deviation from the market being short or long duration, you have to outperform or have a view that's different than what's already reflected into the market. And I would say government markets are very, very efficient at pricing in all the readily available news and information that's out there.
That said, there has been a lot of talk from our clients about moving from government bonds into corporates. Durations are lower and things like that. So how would you answer? I
mean, I would say that at the end of the day, the best way to do it is be diversified. Be diversified across governments, across corporates. You know, have a portfolio that actually captures both. Again, you don't necessarily want to go about timing the move from government into corporate. Again, that's market timing, which we don't really endorse. And at the end of the day, you do it on a diversified basis. You have a long-term time horizon, and that strategy will typically hold well for you.
Yeah. We have a question from George in New South Wales, Parramatta. Who will step into the US bond market to buy $80 billion of monthly issuance if the Fed goes ahead with its threat to stop buying? What would be the likely impact on rates? Good question.
I mean, it's a really good question. I mean, I think ultimately, the U.S. has benefited from, one of the most diverse and widely subscribed to bond markets in the world. And, at the end of the day, there's always going to be a need for treasuries in portfolios, whether or not it's asset managers, global central banks in terms of managing reserves. I would not think, and we do not think, that the Federal Reserve is going to be too early in terms of starting to cut back on the QE. They're going to make sure that the economy is starting to pick up, and we'll see continued holding by the Fed. I don't expect the Fed to actually go out and start selling their portfolio of holdings anytime soon. That's something that would happen way in the future, and in many cases, a lot of those securities will actually run off instead of be sold into the marketplace.
So at that point in time, you actually don't think there needs to be a buyer for them. They'll actually start to mature.
Exactly.
Yeah. We do have another question from Tim at Godfrey Pembroke in Brisbane. If a client is relying on the income return from bond holdings, then there is no reinvestment at higher interest rates if rates were to rise. In this scenario, client's capital can be lost in both the short and long term, so potentially no positive return in a rising interest rate environment. Is that right?
I mean, you're not reinvesting the coupon payments, but you do have maturities that you're going to reinvest, and that's still beneficial. I mean, at the end of the day, reinvesting those maturities, those bonds will ultimately mature, and you will be reinvesting them at a higher rate, which will be beneficial.
Yeah, no problem. We've got one from Bruce in North Adelaide. Why would I invest in a bond fund and risk losing some of the capital when I can lock my money into a term deposit and achieve a similar return? Just so you know, term deposits have been very big in Australia. Mm-hmm. It's essentially investing cash on account.
I mean, you would expect, and we see this in the U.S., I mean, typically in normal market environments, you have an upward sloping yield curve. And so basically what's going on here is you're expected to earn a bigger return over time by investing further out in the curve, by extending a loan for a longer period of time, whether or not that's to a government or to a corporation. So we call that the term premium. So over time, you'd expect by investing in bonds, you're going to pick up incremental return relative to term deposits. And the same thing when you're investing in corporate bonds. It's that corporate risk premium that you're getting for making that loan to a corporation. That's going to be additional yield on top of a term deposit.
Yeah, no problem. Keep the questions coming. We do have a few there, but for Michael in New South Wales, do you see value in Australian inflation-linked bonds? What role can they play in portfolios?
I mean, at the end of the day, inflation-linked bonds, I think, are a good diversifier when it comes to the overall portfolio. When the more you think about inflation-linked bonds, again, if you're looking to make sure that, hey, you have a concern about inflation picking up, it's a way to immunize yourself against that risk. But again, it's viewed as a portfolio diversifier, and there's a good reason to put them in a fund or a portfolio.
So Australian investors traditionally haven't used inflation-linked bonds a lot, or advisors. In the US, I understand that they are used quite a bit. How are they used in portfolios?
They're used as a diversifier again, and ultimately, some folks look at them, hey, as a substitute towards commodities and things of that nature because they are giving you inflation protection, and that's why a lot of folks invest in commodities as well. But again, most folks in the U.S., when you think about fixed income, the bulk of the assets are dedicated to the government, corporate, and some degree the mortgage market.
Yeah. We've got a question from Dwayne in Double Bay. How much of a concern is inflation over the medium to long term? Is the US euro materially different to Australia?
I mean, I would say inflation in general. When I think about the U.S. market, and then we can talk about Europe and Australia. I mean, the U.S. market again, there's no signs of inflation picking up right now. Again, we talk about capacity utilization, the high levels of still unemployment and underemployment. The Federal Reserve has been very accommodative, but they've also have a mission to make sure they manage inflation very well. So, I don't really expect any kind of significant rise in inflation in the U.S. market. In Europe, I mean, Europe is just a very challenging place right now, just given high levels of unemployment, negative GDP growth, so they've been in a recession for a period of time. Even some of the more strong countries like Germany are starting to struggle as well. So, inflation in those two developed markets, I think, is well off in the future. In terms of Australia, we've seen, things starting to slow down in Australia. Again, the mining sector is starting to slow down, the investment in that sector. We've seen the RBA starting again to, keep their easing bias on. They've reduced rates about 200 basis points or so in the last several years. And the expectation from the market is that they reduce rates another 25 basis points by October. So you're not going to see that type of activity by a central bank if you have inflationary concerns.
Yeah. And so a lot of people in Australia have both Australian bonds, but then they also have an international bond portfolio. There's been a lot of talk about not owning international bonds, particularly the European situation. What would you say in an argument against not having international bonds?
I mean, I think international bonds, the bond market is one of the largest markets out there. And, I think, again, being pretty efficient in terms of pricing in news and information, you get diversification benefits from expanding outside of your home market. But what we would say is if you are going to invest in international bonds, it's very critical that you hedge it. You hedge the currency risk, because ultimately if you don't, you're left with increased volatility and not any additional return in the long run. So the key is we think it's a diversifier, but if you do invest in international bonds, make sure you do it on a currency hedge basis.
We've got another question from John, it looks like from Port Macquarie. What current duration do you have on the Vanguard bond funds? How do I select which is the best alternative for my clients?
At the end of the day, a big part of it is really thinking about, hey, what is the time horizon for my client's investment, and really try to tie that in terms of the duration of the funds. If you look at the UBS Composite, which is a broadly diversified bond fund for Australia, it has about a 4-year duration. So, at the end of the day, it's representative of the Australian bond market. If you start going into the international bond space, you tend to have longer durations when you start talking about government bonds and things of that nature. But overall, you want something that's representative of the bond market in Australia. So the UBS Composite with a 4-year duration is a very good proxy for that.
And our Australian bond fund follows that
Exactly.
benchmark, so it's around a 4 duration. And then we've got other funds like a Cash Plus, which are closer to 1 duration.
Right.
It holds much shorter term security. So in terms of for their client, what sort of solution?
The way I think about it, if you're investing in the cash or cash plus funds, those are funds that you need. That's money that you need in the very short run. That's like a savings account, term deposit. That's the way I would think about that. It's really a savings mechanism. When you start talking about investments, in longer term portfolio strategy, you want something where you're going to be able to capture some of the things we talked about, the term premium, the credit premium, and things of that nature. And ultimately, by investing in a UBS Composite-like fund is going to give you those exposures. And over time should give you additional return relative to a term deposit or a cash holding.
No problem. We've got about 10 minutes to go, but there's a few more questions. Rodney from the Gold Coast asks, can you explain to me how hybrids work and how are they different from fixed interest managed funds? We did talk about hybrids at the start, but how are they different?
Again, I'd say hybrids are just very complex instruments that take a significant amount of due diligence and investigation in terms of understanding what the what the mechanisms are in hybrids. Again, the best way to describe it would be it's a combination between an equity and a bond security. It has bond-like characteristics, but it has deferral and other types of things that can allow an issuer to say that I'm not going to make my coupon payments for the next several months, years, if they run into financial distress or there's significant changes in the overall market.
We've got Andrew from Kenttown in South Australia. Given that many Australian companies have been able to maintain a strong dividend yield over the past decade, even through the GFC, why would I want to invest in bonds when the dividend yields from these companies can provide the fixed income proportion at a high yield of a client's portfolio?
That's a really good question, and I guess the best way to think about that is that, again, high dividend yielding stocks, they're still equities. So if you think back to the global financial crisis and what happened to your clients' portfolios during that period of time, clearly you're not going to get the diversification benefits that bonds provide. So when you think about it from a portfolio construction standpoint, high-yielding dividend stocks are not a substitute from diversification and portfolio volatility for a bond. So you just have to make sure you're taking those risks into consideration of what's being baked into the client's portfolio.
Yeah, no problem. The RBA had a meeting on Tuesday where they left rates on hold. What's Vanguard's sort of view on rates in Australia?
I mean, we think in general that rates are going to decline another 25 basis points between now and the October meeting. Again, just the general weakness in the overall economy. There are some bright spots. Real estate seems to be picking up again. The significant decline in the Australian dollar over the last several weeks of about 6 or 7% or so, I think is good from an export standpoint. But at the end of the day, there's still signs out there that there's weakness in the economy, and I think the RBA is just going to be ready to act if needed.
And so you mentioned currency. I'll ask you the question. What do you think of the Aussie dollar?
I mean, I've been in Australia. I went to Australia, came to Australia back in 2011, so I actually lived through the period when the Australian dollar got up to $1.10 versus the U.S., and that was very extreme. And so, coming this trip, seeing it decline now to about 95, 96, from my perspective, coming from the U.S. and just seeing how things are priced in Australia, it still feels overvalued to me. When I look at, some of the purchasing power parity models, it still shows that the Australian dollar is overvalued by, in some cases, north of 20%. So, if you were to look long term, I'd still say we're probably in a downward long-term trend when it comes to the Australian dollar.
And so you've spoken about interest rates coming down potentially 25 basis points and the Aussie dollar also coming down. What impact does that have on bond funds, both locally and globally?
Okay, so when you think about locally in terms of the decline in the RBA, so ultimately that's going to anchor short-term rates, right? And the way you have to think about it, when you think about the overall bond market and the shape of the yield curve, the RBA, the ECB, the Fed in the U.S., the Bank of Japan, their policies around overnight lending rates and their target rates focus on the very short end of the curve. What you start to see as you go further out the curve, that's really a reflection of what's happening in the economy. Is growth starting to pick up? And when you go to the very longer end of the curve, it's a function of what's the inflation outlook. Because when you start getting out to 10 plus years of lending government money, you're really concerned about whether or not there's going to be inflation and are you getting back, depreciated, dollars. And so, various parts of the yield curve focus on different things. Short end is anchored by, the RBA and the domestic market, and then intermediate term is going to be, again, focused on economic activity, and longer term part of the curve is focused on inflationary outlook.
We won't be able to get through all the questions. If we don't get through all of them, we'll provide responses after the session. Short-term interest rate volatility may have minimal impact on the bondholder who's committed to keeping a bond until maturity. If they just hold on, they will at least get the principal back. Does an index fund hold on to its investments in the same way? And that's from Andrew in North Sydney.
That's a really good question, and it depends on the index. So there are some indices out there that typically will sell bond indices that will typically remove securities once they fall inside of a year to maturity. The UBS series of bond indices, the domestic series that we have here, they include bonds all the way up to maturity. So those bonds will mature, and then the proceeds get reinvested into bonds at current yields in the marketplace.
And so therefore the investors benefit from
Exactly.
that.
It's just like them actually going out and buying the security, holding it, and then reinvesting it. The difference here is that you're doing it, having a professional manager create a portfolio. That professional manager is making sure that it's diversified, and you're also getting the ability of that manager to go out and do it very cost efficiently because we're able to transact at better prices than the average retail investor.
Yeah. We've got one from Sanjay in Adelaide. Would you agree that the inverse relationship between interest rates and stocks has changed dramatically? And if so, how do you think this impacts portfolio diversification with stocks and bonds?
I don't think that has changed dramatically. Longer term, I think that relationship still holds. I mean, at the end of the day, when you have the flight to quality, people will still go back to safety. When there's concerns about slowing economic growth or there's a hiccup in the equity markets, you will see people shift back into the high quality assets, which tend to be government bonds. It could be Australian government bonds, it could be U.S. government bonds, JGBs, and we've seen that time and time again.
So you think the correlation won't be one across stocks and bonds?
Absolutely not. Absolutely not. I mean, we've seen, it's one of those things where if you're talking about high yield bonds, you start talking about hybrids or riskier sectors within the bond market, yeah, you could have correlations that become very similar to the overall equity market and very closely tied. But when you talk about high quality investment grade bonds or government bonds, you tend to expect a negative correlation.
We've got one from John in Sydney on bonds and the mark-to-market of bonds. So typically, an effect index fund versus a traditional bond portfolio, how does that impact the mark-to-market?
Well, I mean, every day, the fund is getting priced using the best prices we have available for valuation. So it's reflective of, market prices and where securities could be bought and sold. And so that's really an effective mark-to-market. In terms of whether or not an individual investor goes out and holds those bonds, if they were to go out and need to liquidate those securities in their account, they're going to face the same realized mark-to-market. So the same thing is happening whether or not it's a bond fund or an individual investor. We're just doing it on a diversified basis across a number of securities.
Yeah. We have one from Timothy in Brisbane. Is the credit risk premium in Australia fairly priced?
I mean, I'd say if you go back and look at historical levels when it comes to credit in Australia, and you could look across, not just the Australian market, but the global markets as well. Again, longer term, we look like we're about at fair value. You had some extreme points there during the global financial crisis where credit spreads just blew out to, all-time wides. But at the end of the day, again, our recommendation would be don't try to time the market when it comes to investing in corporates versus governments. Do it on a diversified basis, and ultimately you'll be setting yourself up for success.
We've got one from Angelo in Cairns. If you haven't been to Cairns, Greg, I would recommend you go up there.
It's on the list.
Do you believe we'll have inflation over, say, 5% at any time in the next 10 years, given the rate people are saving and repaying debt?
I just don't. I really don't see inflation going above 5% for a variety of reasons. I think the central banks, have learned their lessons, from the 80s in the U.S. where we had rampant inflation in other markets as well. The central banks are very, very closely focused on making sure that inflation doesn't get out of control, and the policies in terms of how effective they are with reining in, stimulus and all that. We'll see how that plays out over time, but they're very focused on making sure inflation stays under control. That's one of the main things the central bank is focused on, is maintaining that credibility in the marketplace.
Yeah. Another question from Ellen in Hurstville, New South Wales. Given the RBA rate is 2.75, but 0 to 0.25 overseas, where should I expect to get better returns, from Australian bonds or international bonds?
At the end of the day, it's 275 now. We don't know what direction it's going. Again, we would say you want to do it on a diversified basis. So I would recommend, in most cases, hey, have a portion of your portfolio, your bond portfolio, in domestic fixed income, and then go the international route with another portion of it. But again, doing it on a currency hedge basis. It's very difficult to predict, which market is going to give you higher returns over a period of time. One of the things to keep in mind, though, is if you want a rough estimate, a rough back-of-the-envelope way of thinking about it, just take a look at, what the yield is on the index you're investing in. So if you look at like the UBS composite, somewhere around a little over 3% or so, that's probably your best predictor of where, the returns are going to be over the next 5 years or so.
Yeah. We've got one from Josephine in Perth, another good place to go. I thought the UBS composite bond was rapidly getting dominated by government issuance with limited credit exposure. Is this a concern with an index approach?
I mean, at the end of the day, these indices reflect what the overall market is. So if you want to capture the market return, the index is reflecting what the market is composed of. At the end of the day, if an investor or an advisor decides that I would like to have more of a tilt to corporate bonds, you have the ability to make that, but it's making an asset allocation decision away from the overall market.
Yeah.
And there's nothing wrong with that. It's just an active decision that you're making.
One last question from external Michael in Sydney. Does Vanguard have exposure to Greece government bonds in our global bond funds?
We do not. The Greek government bonds got downgraded, so all of our bond indices, both the ones that we run here in Australia as well as Europe and the U.S., are investment grade bond indices. So when issuers get downgraded like Greece, they fall out of our benchmarks, and we ultimately sell them out of our portfolios.
No problem. Thanks, Greg. There's no doubt that fixed income can be a tricky area to understand, so hopefully the points you've made today will help both advisors and investors understand some of the topical issues currently being talked about. Just to close out today, can you give us a summary as to why investors should continue to hold fixed income in their portfolio?
I mean, at the end of the day, it's a couple of things. It goes back to some of the key themes we were mentioning. It's around diversification. There's significant benefits for having fixed income in a portfolio. It helps diversify your growth assets. The other factor is that fixed income provides income. Again, it's a way to create a steady stream of income payments to your clients. But ultimately, you have to think about from the standpoint that you can't substitute high dividend yielding stocks for a bond and expect the same type of return and diversification benefits. The key is bonds play a very vital role, and they serve as an important diversifier. And the very last thing I would say is that when people look at investing in bonds, we've had a very good run over the last 5 or 10 years in terms of bonds. The key thing is just don't expect the same type of returns over the next 5 years, just given where we are in the interest rate cycle.
Unfortunately, that's all we have time for. Thank you, Greg, for your time and your insights today.
My pleasure.
And thank you to everyone watching for taking the time to dial in. Hopefully you found the discussion beneficial. Before we wrap up, I'd like to remind you that the webcast has been accredited by the FPA for 0.5 CPD points. If you'd like to receive those CPD points for the webcast, simply click on the survey tab to the right of the screen. And if you could also give us some feedback on what future topics you'd like to hear, we're looking at running more of these webinars in the future. Enjoy the rest of your week, and again, thanks for your time.
Thank you.